Hey, how's it going, guys? Welcome back to another episode of Weekly Market Update. This week, the market is giving us two extremely important danger signals that you should definitely pay attention to. In this video, I'll do a quick update on the US equity market, the bond market, the dollar, and the gold. Most importantly, I will show you guys what are those danger signs that you should be watching closely in the coming weeks. And also, I'll share with you guys how you can navigate the US equity market for the long term. There are a lot of important things definitely deserve your attention this week, so please make sure you stick around. I promise you I'll make it quick and don't waste your time. Alright, let's get started. Compared with the past 2 weeks, this week the stock market was relatively quiet. S&P was up 1.8%. On Tuesday, the market had a big rally, up almost 2% in one single day. The biggest driver behind this rally was the May retail sales report. The result was very surprising. The retail sales went up 17.7% in May from April's negative 14.7%. It completely crashed the entire Wall Street forecast of only 8%. Apart from the surprising May jobs report, this is another surprisingly good sign showing us the economy is recovering faster than we expected. This is why the market had a very positive response on Tuesday. However, the momentum has been fading away for the rest of the week, and shows some weakness or exhaustion in the equity market. Also, the volatility index, the VIX, stays above the key level of 31 for the whole week. That shows, despite the great numbers from the May retail sales report, the selling pressure in the stock market actually came back and stayed for the whole week. So what exactly is going on with the stock market in the most recent 2 weeks? Should we be worried? Whenever I have doubts, I always come to these two markets to look for answers, the bond market and the dollar. I call them the markets of the truth. In the bond market, the 2-year yield barely moved for the whole week. But what I truly want to show you guys is the 10-year yield and the 30-year yield charts. On both of the charts, we can see that the yield has crashed again and came back to this bearish range. If we want to see a bull market in the equities, we want to see the yields break out from this range and go higher. But what we get from this week is that all three major treasury indexes, the short-term 2-year yield, the mid-term 10-year yield, and the long-term 30-year yield, are all back to the bear market territory again. This is a very dangerous sign for the equity market because the bond yield always moves ahead of the stocks. Whenever we have a strong upside resistant pressure on the bond yield, we should definitely expect the selling pressure of the stock market coming soon. Alright, now let's take a look at what the dollar tells us. The dollar continued its V-shaped recovery from last week's low. And most importantly, the dollar had a very bullish breakout from the key resistance level on Friday and closed above it. So this is definitely the sign of a short-term strength. Also, the European Central Bank, Bank of Japan, and the Bank of England are all going to start their new rounds of QE in their own countries over the next couple of weeks. This will add even more strength on the dollar, and can potentially push up the dollar price even further in the coming weeks. If we want to see the stock market continue its rally, then we definitely want to see a weaker dollar. But what we are seeing this week is the dollar rally seems to come back. So the dollar is giving us another extremely important danger sign for the stock market. Alright, so here are the two really important warning signs that deserve your attention. You should definitely watch these two markets very closely for the next couple weeks. One more thing I want to highlight here is that although we're having two dangerous signals from both the bond market and the dollar, they are not a sell signal for the stock market yet, at least not for now. What I believe is going to happen for the next 1 or 2 weeks is that the stock market will enter a consolidation phase. It will not go significantly higher, but it will not immediately crash either. After this consolidation phase, especially when the bond market and the dollar make some new significant moves, that's when we will have a much better clue where the stock market can potentially go next. The gold remains extremely bullish. It has been trading within this classic ascending triangle pattern for the past 2 months, making higher highs, and finally we're close to the point where the gold might have another strong breakout to the upside. So the gold also deserves your attention for the coming weeks. Once it breaks out from this ascending triangle pattern, it will definitely be a great time to add more positions on gold. In the last weekly market update, I shared with you guys how to navigate the US equity market for the short term in the current market environment. And this week, I will talk about how to navigate the US equity market for the long term. For the short term, the Mr. Market may not move based on economic data, but for the long term, the Mr. Market will eventually reflect the economic reality. Then what is the economic reality that we're heading into? To understand this, we need to take a look at where we were before this pandemic. Before the COVID-19 pandemic, we were already in a classic late stage of the long-term debt cycle. Basically, we had a slowing business earning growth, we had low corporate tax, we had low inflation, near zero interest rate, and plenty of liquidity in the market. And where are we now? First, we have a global income shock, which caused by the pandemic lockdown. Second, this income shock plus the lockdown collapsed the spending in our economy. Third, we have the biggest fiscal and monetary response in the entire US history. Zero interest rate plus more than $3 trillion QE. Also, we have a serious duration mismatch between the virus impact on the income and the spending relative to the fiscal and monetary response. This could be devastating. One classic example is that the stock market is going up like crazy, but the real economy is still in a bad shape. And that leads to two important long-term questions we need to answer if we want to navigate the US equity market for the long term. First, will this COVID-19 crisis bring a long-term or even a permanent shift in the macroeconomic trend? Second, when will we enter the ultimate insolvency crisis? Let's take a look at question number one first. The easiest way to understand the economy and use it to navigate the financial market for the long term is this flywheel model developed by Ray Dalio and his hedge fund Bridgewater. Basically, the whole idea is that there are always two sides of any transactions in the economy, the buyers and the sellers. So the sources of money should support the uses of money in the economy. There are three major sources of money: money supply from the Federal Reserve, credit from the central bank, and the income from business and individuals. All this money will be mainly used in three different ways: spending on goods and services, purchasing financial assets, or saving as the reserves. For example, when one person spends money, it will become someone else's income. And then that person will spend that income back to the economy. In a healthy economy, we want to see this income spending flywheel turning up. But what is happening right now after this pandemic is that first, because of the lockdown, many people lost their jobs, which leads to income loss. Then this income loss leads to a dramatic decrease in spending. A decrease in spending leads to even more business closing down and more jobs lost. The income spending flywheel enters a vicious circle because of the COVID lockdown. In order to replace the income loss during this pandemic, the government increased the money supply and gives every American stimulus checks to replace their income so that they can have more money to spend. But the problem is, when the whole country is still in the lockdown, sports, parks, malls, casinos are all closed. Even though people are receiving money, they have nowhere to spend. This is why we're seeing this crazy collapse on personal spending in the US. Within 2 months, American Personal Consumption Index dropped to 2015 level, retraced back all the way to the 5-year low. So what people actually did with all that free money is either buying stocks in the stock market or save those money in the bank. That is why we're seeing this huge jump in the retail trading account numbers. These are definitely some extremely unusual numbers. Also, a huge volume spike in Robinhood retail account record right after the COVID lockdown. The savings rate in the US is also going up like crazy. Right after COVID-19 lockdown, the saving rate went up from 8% all the way to 33%. All these numbers are showing us one extremely important fact. The Federal Reserve can print unlimited helicopter money, but they cannot print a real functioning economy. 70% of the entire US economy is dependent on consumer spending. With no real spending, there's no real inflation. With no real inflation, there's no real bull market. This is one of the biggest reasons that many heavyweight hedge fund managers are extremely bearish on the stock market. They are bearish from the long-term macroeconomic perspective. So if you are a long-term investor, one of the single biggest questions you should answer is that how confident are you that the spending power will start picking up and grow into the economy to drive up the real inflation? Yes, we do see the May retail sales number looks great, but that was mainly supported by the government stimulus checks. Many Americans nowadays are even earning more money during this lockdown than having a full-time job. Is the government gonna keep giving people free checks forever? What will happen once they stop giving people free money? How much money will consumers spend into the economy? We're seeing a dramatic consumer spending behavior change during this COVID-19 crisis. Will this consumer behavior shift bring a much longer change into our economy? These are all the extremely important long-term questions that we need more ongoing economic data to answer. All right, let's move on to the question number 2. The potential insolvency crisis. To understand the insolvency crisis, we need to understand one thing. It's called a zombie company. So what is a zombie company? This term originally came from Japan during the huge financial asset bubble back in the 1990s. Basically, zombie companies are the companies that are heavily in debt, although they can generate a certain level of revenue after cutting the operational cost. This revenue are only enough to pay back the interest, not enough to serve the loan principal itself, which means these companies will never be able to pay back their debt. The only two things that make them still surviving are the low interest rate and the central bank's unlimited mercy. So how many companies in the US are considered zombie company right now? Based on the research from Deutsche Bank, the number of zombie companies in the US have grown from 4% back in the '08 financial crisis to 20% in 2020. Basically, right now, every 5 companies in the US, there is one zombie company. And that is a mind-blowing number. Zombie companies have been sucking a lot of money from the US government, and they don't really contribute to the real economic growth. But why does the government still want such companies to exist and feed them with the unlimited debt? Pretty simple. It's because of the jobs they provide. We have already more than 30 million people out of jobs in the US. Just imagine if the government stops their support and let those zombie companies go bankrupt, how many more people will lose their jobs? And how much bigger impact that will bring to the economy? If you wonder how that will affect the US stock market, just take a look at Japan. Since the term the zombie company originally came from Japan, we can use the Nikkei index back in the 90s to give us some historical references. The zombie companies started rapidly growing during the late 80s in Japan after the 1987 flash crash in the market. The Japanese government injected a massive amount of debt into the banking system and forced the Japanese banks to lend this money to the business with extremely low interest rate so that it can stimulate the economy. And what that did is that created a huge stock market bubble as we see in the chart. This is also the time that zombie companies in Japan grow like crazy. When the zombie companies eventually collapsed in the mid of 1990, the Japanese stock market immediately crashed and entered a 15-year bear market. This long, painful bear market caused the Japanese stock market to lose almost 90% of its value. And even until today, even the Japanese central bank is buying almost 70% of the stocks in the market, they still cannot recover from the peak. Now back in the US, as for the insolvency crisis, it is not a matter of if it will happen. It is the matter of when it will happen. Even though for the short term, the US stock market will still go up and make new highs, but eventually we will have the reality check day. And when that day comes, it will end really bad. We have seen Japan completely collapse in the 90s and enter a 15-year-long bear market. Right now, the US is on the same track. That is why on Friday, in the Bloomberg interview, the legendary investor Ray Dalio sent all of us a warning message that the US stock market might enter a long, painful lost decade very soon. So, in conclusion, based on my own analysis, for the long term, I'm more on the bearish side for the stock market. If I have to invest in the equity market, I believe the emerging market offers a much more attractive opportunity to invest for the long term compared with the US. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and business, and find my videos have been valuable to you, please consider subscribing. Thanks so much for watching, guys, and I will see you guys soon.